One of the biggest fallacies, misnomers, incorrect things is all these people in real estate think it's about real estate. It has nothing to do with real estate. If you have the wrong partners, they cost you more than anything in life. And I've been through that. Those are the worst beats I ever took. The others are math equations that you can step away from, lose your money, make it on the next one, and start feeding back and getting going. But relationship building, relationship capital, that is going to take you through all different types of cycles.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today's guest is Joel Kraut. He's the co-founder and managing director of BRRRR Loans, a direct private lending firm focused on fix and flip and small balance commercial deals. He's got over 20 years of experience as an investor, a broker, and a lender. He's got deep expertise in hard to finance assets and BRRRR style lending. What sets his approach apart is a disciplined view of leverage. He focuses on using private capital with intent, slowing investors down, and helping them build durable wealth without blowing up from bad debt or bad partners. Joel Kraut, we're excited to have you with us today, sir. How are you?
Guys, thanks a lot for having me on. You know, we always joke in background, like truly passive, as we talked about off camera. Is it really truly passive? But for all of us, you know, it's our chosen lot in life. I'm a real estate junkie. I've been at it since 1996. It sort of evolved from reading books to getting active and just continuing the process, being insane enough to just show up every day. And here we are, you know, years later. Last year, we let $300 million out of our office, and we're expecting to double that this year. So, you know, we've been really blessed, and it's been a great ride.
Joel, we've only interacted for a very short period of time before recording, but anyone who's candid enough to bust our chops for the name of our podcast within the first 30 seconds, we're going to get along. We're going to get along great, because what I value is candor and honesty, and you shot us straight from the first second that we talked to you. And I know you're going to continue to do that today, and I'm excited about that. And you're exactly right. The name is tongue in cheek, because
Absolutely.
there is really nothing that is truly passive income. It's all on a scale, right? Something is the most passive, something is the least, and everything else falls in between. Sometimes it depends on how much work and preparation you've done ahead of time. However, hard money lending or BRRRR lending is one of those things that a lot of the work you're doing up front is on qualifying the buyers, on qualifying the property. And after that, it becomes fairly passive and in a good spot on that scale. So tell us a little bit about, I'd love to hear more about you and your background. You mentioned that, you know, you've been doing this for quite a while. You've been through some market cycles and you are seasoned. And I think with that comes a lot of wisdom. And I'd love to hear more about that. And then for those that don't know what BRRRR is, we've talked about it many times on this podcast, but love to hear a brief explanation or your explanation and the type of lending that you guys offer.
So we are a typical fix and flip, 30-year fixed rate, commonly referred to as the DSCR style loans. And we do a lot of new construction spec houses out of the ground. We can do some small multifamily construction, but most of our construction is 1, 2 family, maybe a 4 family, not that many larger buildings. We've been doing it for a long time. I bought my first investment property in 1996. And about 10 months later, a young lady came to me, truthfully, showed up in my office, had never met her before, quickly introduced herself. I didn't even really make out what she'd said. And she told me that she thought I bought my property really cheaply and it was worth a lot more. We could refinance the property and I could get all my money out. Now remember, this is 1996 going into 97. I didn't even realize that the mortgages were recorded public instruments. I got nervous, like somehow she knew this info on me. I called a friend of mine up who'd sold me the property, my realtor friend, and walked her through the process. And I started out by saying, Mindy, please don't laugh at me. And of course she started laughing because I asked if it was legal. I mean, I was a Wall Street guy trading derivative products. And I'm like, wait, you're telling me you're going to give me all my money and I can get a check above that? I still own the property. It's going to cash flow and I still have equity. The light bulb goes off and you can imagine. So that mortgage rep, who I consider one of the sharpest ones I'd ever met, explained her theory. Instead of going to look for all 3 of us to go buy our next house every 5 years, she went into the county records and found where the 3 of us owned more than one mortgage. And she would approach us when one of those mortgages hit the 10-month mark. Because back then in the 90s, you could not refinance the property to market value to 12 months in a day for seasoning. Now that's changed dramatically, but back then that was the rule. So she would only approach the 3 of us when we got to the 10-month mark. And she did hundreds of loans a year instead of trying to find 20 new homeowners a year. And In that, she built a repeat customer in me because I went on and did 22 loans with her in the next 2 years. So we started to understand what was happening. I didn't know 20 years later that'd be called BRRRR, buy it, renovate it, rent it, refinance it, and repeat it. It just seemed too easy. So we started to do it. And through that, we started to find the opportunity to flip a house or two. And I was doing a deal in Newark, New Jersey, and I was working on two houses on the same block. And a couple guys came over to me, it was a little different neighborhood, if you know what I mean. And they're like, yo, what's up? How do you do two houses on one block? And I explained to him how I got the money, basically from friends. At that time, it was 14% and 4 points. Now, the markets had a lot more meat in them back then, so you could definitely afford that. And my friends would lend me basically 90% of all the money, sometimes 100. So they asked, could you do that for me? So we turned around and lent them less, but we started a little lending business out of it. And that kept growing over time as well. I really learned about hard money lending in the crash in '08. We had a 31 unit condominium complex going up, ski on, ski off at Hunter Mountain, New York. We were just about done. The markets really implode. Our bank at the time calls us up and says, look, we have a problem. We can't fund anymore. Like, well, we have deposits on all these properties. We're going to get sued by God knows how many homeowners here or potential homeowners. We met a gentleman who was a private lender. I had never met somebody like that before at that level. I'd just done it with buddies who were, I didn't even call them private lenders. They were my friends who gave me money. I didn't even put two and two together. But this was a professional person who did this. And he lent us the money to get us through, in this case, the last four build out of the units. And in particular, we paid him back from the sales. We sold those units a lot lower than we had sold for the last 12 months, but we got out of the job and we're able to walk away with our heads. So that was my first exposure. And I just thought, this is a great business. I mean, the guy's in first position. He's got a ton of collateral. Guy's desperate to pay him. There's something here. This is not just one guy on the street that we're going to lend, $110,000 to. This was $1 million. It was a whole different world. So you started to put two and two together, and fast forward all these years later, I never really thought it would get to this point, but here we are. It's kind of amazing.
It's so funny. You mentioned your first time you sort of become aware of the entire idea of BRRRR. I had a similar experience. I think the first time I heard it, it took me an absurd amount of time for the concept to get through my thick skull of using a short-term loan to buy and to basically fund the purchase and rehab of a property that I would then use another loan to go into a longer term. It just did not compute for me for the longest time, and I think I finally somebody finally explained it on the Big Pockets forum in such a way that it got through my skull. But it's still, to this day, you'll explain it to a civilian and like, wait a second,
Right.
you have two loans. Well, that's high risk. So then you're paying two loans.
You're
Like,
building
no.
a house of cards.
Yeah. It's like, no, I'm forcing the appreciation on the property with the first loan, and then I'm going and getting another loan that pays off the original loan. And they go, what? And then it just doesn't compute for the average person.
Yeah.
Well, the concepts of value add are foreign to most people, right? I tell the guys in the office, the men and women, and when we travel and meet groups, you have to still remember 9 out of 10 people have never gone to a real estate meetup or spent time on the BP platform, Bigger Pockets platform, or gone to any of these types of events. So to your point, when you're speaking to them, I used to get questions or questioned. What do you mean someone's going to sell you a house for a discount? I don't believe that. Why would any idiot do that?
Mm-hmm.
Why would you buy a house you're not going to live in? Right? I used to get those types of questions way back in the 90s and early 2000s because there was no HDTV. The lady didn't pull up a Lambo, have perfect hair and nails and skin on a job site. It was like guys that were rusty and crusty like me. And, we'd fight our way through these jobs and make some money quietly and go home. And it wasn't publicized unless you were up at midnight to 4 a.m. watching Carlton Sheets. There was nobody else available. So it became an industry. It became really a professionalized industry probably between 2012 and 2014 when it dramatically changed. And, a telltale sign, we had pop-up banners, we had one-page handout flyers, pamphlets, advertising. That had never existed before. I was a guy who was in a car, smoked windows. I'd roll past you two, roll down the window, you throw in the payment and go. That was the feeling. And when you didn't pay me, I was going to steal your property. That was sort of the impression of a hard money lender, right? I was a wise guy, basically. And that had changed so dramatically in that second decade of the 2000s as normal people, for lack of a better term, began to get access to some of these houses because it was just an inventory that was massive. It was unbelievable. And you've quickly figured out, look, I could put some money into it, unlock some of the value, like you just said, Neil, and now make a profit. All of a sudden, this is a business. Now I'm a good guy. I'm not a bad guy lender anymore. I'm helping you make money, and the whole world changed.
I think it was between 2011 and 2013. My wife and I, we were in Columbia, South Carolina. I bought 9 single family houses because I could buy them post 2008 crash for 25 to 30 grand for a brick 3-bedroom house. And they were renting for $800 a month. It was crazy. So that was 2011 and 2013. And then I think it was 2015, I looked at the equity and I was like, oh, I could refinance these. And I like accidentally bird them several years later. And that was the first time I heard about it. It was like 2015, 2016. And for me, that was the kind of time it was off to the races after that. For not off to the races, but like it became less of a niche product and more Main Street, right? At that point. One of the things that I wanted to ask you about being a lender, and this is a niche lending product for this type of thing, is the one thing that is hard for you to control is deal flow. And right now we have this situation where the interest rate shot up at the end of 2022 higher and faster than they ever have, which is one wrinkle. And 2 years before that was COVID. And during COVID, we've had this astronomical appreciation in prices when you had these compressed cap rates due to really low interest rates. And the commercial side was priced really high. The residential side is now priced really, really high. So your basis is so much higher. And then, yes, interest rates historically are not high. Now, when everybody has recency bias because you had 2.8% interest rates a couple years ago, that's one thing. But historically, they are not high. But it seems to me like it is getting challenging to find properties that will BRRRR because the values are up. The cost of materials and renovation is a little bit high. The interest rate is a little bit up. And also the thing that compresses when those interest rates go up is that the LTVs sometimes change. So maybe you could refi to 80 or 85 or 90%. But in the commercial world for us, we went from 1 year getting 80% LTV or LTC, depending on what you're doing. And the next year it was 65% and sometimes 60%. So that's limiting the amount of equity you can pull out of the property. So help me understand, like you have to navigate and bob and weave to create a product that's going to work for these certain types of investments when there's so much turmoil in the market. How do you navigate a time period like?
Well, for one, having gone through a couple decades, the markets are always going to do what the least amount of people expect. And you have to be sensitive to that. So when you see people really on the bandwagon, that's the beginning of the percolating of getting nervous, right? So for all the young people in the industry, I don't mean just chronologically young, but new to the industry I'm referring to, they're buying as many properties as they can at 4% interest rates and never considering any of the cash on cash returns of the money they're putting into the properties. That is a recipe for disaster long term. At some point, rates don't go down anymore. And to your point, everyone knew they were going to go up, right? But very few, if any, predicted 200 bips in 1 month. Right? Nobody really saw that coming. And we could see deal flow in our office shrink for that 6-month period dramatically. We're probably off 30%. And slowly over time, it's come back. So what you're seeing a lot now are more seasoned investors participating. Now, you're also seeing tremendous rotation. The California, Texas, Florida investor from wherever they came from around the world, or if they lived there, have rotated into more traditional cash flow positive markets, which aren't as exciting on appreciation, but can cash flow you through the next 3 years and keep your portfolio moving successfully so that as things change and maybe rates do trickle back down into the 5.5 range, we're not that far. We're doing loans now at 6 to 6.5, dramatically different than 8.5 in that quarter that you're talking about in 22. So that's helped our business and our industry dramatically. We have just about all, exceeded previous numbers now. And that's with rates being 50% higher than they were at the low, right? We're saying we're net increase in volume with rates going from 4 to 6, right? A 50% increase than where we were at 4%. So it's really a testament to the play out there. Look, I'm a long-term guy. Investing in these types of properties has really been around since the beginning of marking time, the beginning of the Bible. People have paid for a place to stay, work through, storage, transportation hubs, whatever it is. And like until Amazon, Google, and Apple take that away, which they may invent the George Jetson pill overnight and banish us and come back. I'm still a believer. So I believe our business will double or triple in size over the next 3 to 5 years. And most of our industry, the bigger players are gearing for that. Big move forwards with AI and technology, et cetera, to help keep costs reasonable so that everything in the world doesn't necessarily just go offshore and helping us all navigate that. So I see big rotation. We have never done as many loans as we do in Ohio now. Kentucky, West Virginia, Alabama, Mississippi, Louisiana, Oklahoma, Missouri, Michigan. I mean, dreaded Michigan, right? You think of Michigan, you think of 8 Mile and then half the city's burning down in your head. But that's not what's going on there anymore. And as people have become aware, entrepreneurs are interesting because they find problems and they go solve them. And in this case, they're tying it to real estate so they can make money. But the key focus is in any business, just like you guys take properties and reposition them. It's finding problems. Kmart sucks, haha, right? That was the tagline for a while as they kept folding up. But you're also going and understanding the demographics and what the need is. And as you see development and new construction and road work, you know there's going to be a need for storage, right? I mean, that goes hand in hand. And also with big transitions all over the country from COVID where people moved, that put big pressure. And you see the U-Haul statistics are up tremendously. So you're looking at some of the non-obvious, but still free things to research to help guide you to keep your finger on that pulse, to your point. And rotation has been the key. We have had to do that, had to really pay attention to respect it. We've spent infinitely less money marketing in Florida and Texas and much more in Alabama. It was like, what, Alabama? I mean, Ohio? God, no one likes Ohio. Pennsylvania? These are boring states, but man, things are happening. So, you're right. We all have to pay attention. It doesn't matter how smart we think we are. The market is smarter. And if you don't listen, you lose. So we have to always do that. That's one good thing I learned as a trader on Wall Street. If you don't recognize the trends early and jump on board, you're a loser.
All right. So I have to ask a clarifying question so I understand what you're talking about exactly. When you use the term rotation, what are you talking about?
Well, for a long time, most of the Middle East was investing in California, Florida, and Texas. South America, same 3 states. But now you're seeing those same foreign-born American or foreign nationals investing in Pennsylvania, Ohio, Michigan, Missouri. So you're seeing rotation to non-super big appreciation states, but more cash flow friendly states. That's what I mean by that.
Interesting. What's so the current terms that you guys are operating under? I've explored. I'm flipping a couple houses right now, which I did. The last time I flipped houses was probably 15 years ago. But I've got 2 that we're flipping right now. We're just funding them ourselves. But I've been shopping around at some of the different fix and flip loans that are out there. I'm seeing 11% with 3 points, but minimum of 6 months seasoning or 6 month hold time. You can't do anything less than that. I've got another group that's like 13.75% with 2 points. They'll do 3, 6, or 9 month terms. And a lot of them seem like they are adjusting. And one of the things I realized is one of the groups, they are raising money from investors and they're paying 8 to 11%, depending on what tranche you're in and how much money that investor invests. And then they're lending it out at 2 points and 13.75%, which seemed a little high to me. But they're turning the money very quickly. And the difference is they're raising this money from investors. They're lending it out at a higher interest rate. They're actually spending a lot of that difference on their marketing and things like that. Where they're really making the money is on the points. And the key is how many times can they turn the money? Can they turn the money 2 or 3 times in a year? Because then it's not tied to the annualized interest rate. It's tied to if you're getting 2 points and you're getting that 4 times a year, that's 8% on top of the interest rate. Is that kind of the traditional model of you want to, like, the money that you're lending? Is it private money? Are you guys raising that money? And are you trying to make difference on the spread or is it on the points?
So we actually do both. And you bring up a very good understanding and overview of what's going on out there. So when we're really lending our own money, we are doing exactly what you just described. We're putting in some of it. Let's say it's $100,000 loan. Myself and my son, who's my main partner, probably put in 25,000 of it. We raise the other 75 from co-lenders. We're giving them an interest rate. We're making that scrape on the rate between what we lend at and what we pay them. Plus we're making the points, the fees. So yes, that's a huge business. It's a very good business, but the big boy money is made in the full interest stub. And then how fast you can turn it to add fees to it to enhance it, right? And now your rate of return is going to be, on a bad deal, 20+%. On a really sexy deal, it could be 30, 40, 50% annually. So people don't really understand how the money works. They think it's about the loan, and they're kind of missing that, which is fine. We appreciate that they missed that. That's good. It works for both sides. Then we're also doing this quasi-institutional. There are a lot of institutions that you know the names of that are bringing gigantic money to these markets. So for men and women like yourselves who have that kind of experience, we can lend down to 8.99. If you wanted to, you could buy it down even lower to 8%, 8.25. We could charge 1.5, 2 points max. We just did a deal at 8.99 and 1. It was a $2.8 million deal. So we brought the fees down a lot. And that person also is only going to pay interest as the money's drawn down. That's a big thing when you're out there talking to people like me. You must always make sure you understand that. That is a key question to ask. You want to make sure you're only paying money as you draw it down, not from day one on the full loan amount. We've seen numerous people call us up. They're all upset at the last minute. I didn't realize this. Well, part of your responsibility in your own due diligence is to read a few things and ask questions, right? We can't substitute for that. Some people are not good people, and they don't bring it up on purpose because they feel you're a little green and they're going to get you. We definitely don't operate that way. We don't like that anybody in the industry operates that way. It's not good for our overall business, and it leaves a black eye for us all. We are trying to be ethical, fair, transparent, stay away from the image of the old hard money lender. I mean, we're a quasi-institutional shop and a true private shop. We do both. Sometimes people will call me on a Thursday night. I'll literally go see the property over the weekend if it's within, let's say, 2 hours of me, and then we can close by Monday night, Tuesday. On those deals, we're doing what you're describing, probably charging 12 to 13, 2 to 3 points, and lending about 70% of the cost. But on the other deals, if you're going to fix and flip something and you go to contract and you have 15 days to close, we can do an appraisal with your renovation budget. I can charge you 8.99. And depending on the loan size, anywhere from 1 point to 2 points. Well, that feels a lot different. That makes some deals more workable. And I can also be insane enough to give you 90% of the purchase price, 100% of the renovation. So, and there are lenders out there that will do 100% of purchase and 100% of renovation. So there's a gambit out there. You as a borrower should really be studying that market all the time, introducing yourself to people. Look, in anything we do in any business we're in, if you don't tell everybody what you're doing, you're making a mistake. Just tell them what you're doing and shut up. Eventually it'll match up if you're telling the right people.
Low hanging fruit. Here's a question. This is a personal question that I have not always understood really well. Okay, so you're the private lender for this. I mean, great product. You're helping people accomplish goals and move forward no matter what the market is giving them. I love that. In your position, when you're talking about earning the full interest, you are only making money and your investors are only making money when you have deployed capital, right? So let's say that you are making 30% per year, but then let's say that you can only turn that money half of the year. That's an effective 15% return. How do you factor in, like, if you're putting down the 25 grand for $100,000 loan with your son, you have somebody else funding the other 75, and it's a 3 to 6 month term or 9-month term or whatever it is. At the end of that, they're getting their payout. Is there another opportunity for them to roll right into, or are they investing into a fund and that fund is going to continue to pay out regularly? Because at the end of the day, the money is only generating income when it's working. How do you balance that side of it?
That's a great question. And a lot of people have moved to the fund scenario where they're paying people a preferred return, and there's cash drag issues. So you need to have the money ready to move all the time, because cash drag, meaning having the cash literally sitting in your account, can be very expensive. You can go to high yield savings accounts at the Vanguards of the world and you maybe get 4 or 4.5%. But if I'm still paying you a preferred return of 7 or 8, I'm still have a hole to fill, right? So I need to move that money along. In our business, we've been around a long time now. So we're fairly fortunate that, yes, we pay you back, and literally the next week or so, we can put your money back out if you want. So that has taken a long time to develop, though. That's not a startup scenario. We and myself, I really like the deal by deal scenario. If you don't like that deal, you shouldn't have to invest in it. right? It's still your money. I want you to feel totally comfortable. I think it's a good deal. I'll put mine in. I'm willing to lose mine before yours too, by the way, which I think people like. And we tell you what the differences are up front. No hidden secrets. You see it in the documents. We tell you out loud. If you're uncomfortable with it, maybe this isn't right for you, and that's okay. We'll catch back up down the road when it feels right. So for people, like we're doing one deal now in Alabama, the gentleman has the money literally sitting undeployed in a Roth IRA, and he's going to give it to us, and he's going to make 12% on it, and we're going to flip the house. It's a good deal for him. He's in first position. He knows us for a while. He feels comfortable with us. The price points we're participating at in the market, you can always lose. There's always risk. Things change in the world that are unanticipated. Proof COVID, right? There are other things that have come up too, but proof COVID is one that keeps a lot of people honest mentally, where they get out of, I don't think I could lose mentality. And it's a very reasonable risk for even a layperson to see that at this price level, it would be hard to get hurt. Could we lose 5 or 10% of the capital in a disaster? Maybe. But is it more likely that we won't make 30% returns on the flip and only make 10% returns? Yes, that would be the bad scenario. And honestly, at this age, I mean, you guys can see I'm not a little kid anymore. At this age, I personally only flip houses where I can make some money, not tons. I'm not interested in that. It's too much risk for me. It's kind of how I got this haircut, building that, portfolio in the sky that was going to all work great. And, I thought I was a smart guy till I wasn't, type of thing. So we're more conscious of that now than ever before.
So the last two BRRRRs I did were late 2019 and very early 2020. I didn't even realize at the time how much I got in under the wire before COVID shut everything down. And at the time, I was smart. I used a HELOC to buy a property. Was on the phone with a lender before I did anything. Told them exactly what I was doing, how I was funding it, and had my permanent loan, the BRRRR loan, lined up before I signed the docs to buy the property. And at the time, you could very easily pull out. I think I pulled out 80%. It's all, of course, dependent on the ARV, what the appraisal comes in. And I think maybe on the one in 2020, I think I had to leave about $3,000 in the deal, which was nothing. Really felt like I got off well. How has that changed? Now we're in a much different lending environment right now. How has that changed from, let's say, sort of the good old days of, late 2019, early 2020 to now where we are right now?
Well, I'd like to split up the good old days differently than you just did.
Okay.
I believe the good old days are from the beginning of the Bible till whenever, meaning now and into the future. Because, oh yeah, we do have this on tape and it should be replayed ad nauseum, because what you described and how you got ready and how you laid it out and how you had the process down before you entered, that's why you were successful, sir. It had nothing to do with the market. It had to do with your preparation. You now account for 1 out of every 10 investors. You guys have met them. We meet them all the time. It's unbelievable to me in the world of due diligence, one of the most misused and abused words ever. Well, my friend said it was a good deal. The realtor said I couldn't miss in his zip code. And you put out $400,000 or you signed for $400,000, you make $92,000 a year and you just signed for $400,000. You make $30,000 a year and somebody like me let you sign for $400,000. We both had no chance, right? The people who prepare in the manner with which you described are successful yesterday, now, and in the future. When someone comes to me like you that is prepared like that, we are going to do better for you on rates and terms because you're going to make my life easier. Right? Think about how organized that person was. And people are often surprised to learn, and I talk about this publicly a lot. A lot of times it is single moms. And people say, what? What are you talking about? Well, think about it this way. The single mom has had to manage a budget forever. They're the logistics manager, right? They're a scheduling manager. And last I checked, those 3 things are huge on a fix and flip project. So those personal traits, qualities, and experiences translate well to what they're trying to do. Versus a lot of people who look like me and think, oh man, I got it. I'm good. I don't need to understand what the materials cost. I don't even need to understand what goes. I got 3 bids. You have no idea what they even are. So preparation and understanding your exit before you get into it, multiple exit strategies, these are not just terms. These are things people need to participate, master, plan out, and be prepared to execute as markets change and things evolve. And if you don't, you're going to suffer the consequences. I'm not trying to make it bad for anybody. but that's reality. And if you're prepared, you can be successful. I think it was Branch Rickey once said, I wrote it down once, like luck is the residue of design, right? So if you prepare, you're going to get luckier. Well, it's no shock. So to me, that's a big part of the changes that are out there and what you need to be aware of and doing all the time. And
Have there been any changes in the seasoning period? I mean, that was kind of where I was, where I was going with that is that I knew going in that I was going to be able to, if I hit this ARV, I knew I was going to be able to get this money out. Whereas I worry now that there are a lot of people that may think, oh yeah, we're just going to, we're going to get this done in 3 months. And then the bank's going to go, yep, 10 month season,
Or 12.
or 12 or
Or
24-month seasoning period.
so I will say that because of the way money works, and you guys know, the pressure to get money out is unbelievable. So every week that goes by, we just kind of make it easier and easier for the people, not harder and harder. I know that sounds insane, but it's actually true. If you can show you've renovated the house, seasoning is 90 days. Some
Wow.
lenders will do it with 0. So if you can show you renovated the house, basically at day 91 of ownership, not when you completed your renovation, but from day 91 of ownership, if you show your renovations without receipts, by the way, without receipts. So the pictures say, hey, I put a new roof in. New roof was 14,000, even though it was 8. The windows were 9,000, even though they were 6, but they look new in the pictures in the appraisal. We can qualify it. I can give you the lesser of 75% of the after repair value or 120% of your cost. And when people give us that initial renovation budget, do they aim a little high to add to the cost so they can get more? Probably happens out there. Probably,
It's 75% of the ARV or 120% of the cost, whichever is lower of the two?
Yes. But
Got
you'll
it.
be surprised. You won't be surprised to find that in most of America, when you look that up and sort of really work through the math, as Neil did before, they're going to be very close, or the cost will be slightly within a couple of percent of under 75. Not a lot. People, the appreciation has flattened out a lot. So now you're really unlocking value back like the old days. You bought houses, you renovated them, you unlocked value. You didn't think they were increasing $30,000 in pure value while you were doing the job, like during COVID. So seasoned players, the more well planned out players, the people who go to really good mastermind groups and get good advice instead of just rah rah sell stuff, those people are successful. That's the truth.
I love that you talk about beginning with the end in mind. That's basically what you're talking about. Like on a BRRRR property, it's honestly it's similar for a flipper as well. Like the flipper starting with the ARV, that's an oversimplification, but you better start with what's this thing going to be worth when I'm done with it, and then let's subtract the construction cost, the carrying cost, which most people get wrong, the cost of the lending, which most people get wrong, and then everything, a lot of other things affiliated with that, and then you got to factor in what you want to make, and then you got to realize that you're going to be wrong on the amount that you're spending on the renovation and how long it's going to take you on probably the first 3 to 5 of them that you do. And you got to kind of navigate through all that. But ultimately that's a BRRRR property is basically, this is an oversimplification. I haven't thought about this till just now, so I'm not sure how this is going to come out, but it's basically a flip property, but you know who the buyer is. The buyer is the bank that's going to be willing to refinance it at the end. They're going to do it at a certain percentage of LTV off of your after repair value. So you still better get that right? You better know who the person is that's going to buy this flip, or you already know who the buyer, quote unquote, buyer is for this BRRRR. You better work backwards from the beginning with the end in mind. You have to have your exit pre-designed. Is that fair to say?
I think it is totally spot on. And I would add, you're speaking in front of an audience. You want to start off with some warm up thing to get the audience engaged and truly passive, right? So you ask the audience the obvious question: what's your number one financial goal for the next 12 months? Just write it down. And you look into the audience. Usually there's a couple people falling asleep, but now you as the speaker can see the stress on their face because it's hard for them to write that down. How are you going to be successful? How are you going to get to where you want to go if you don't even know succinctly where you want to go? And to your point, if you haven't planned the exit, you haven't planned, right? How can you get there if you don't really know succinctly where you want to be? It's permeating through everything in your life. This isn't just about flipping a house. This is about cleaning up your house personally and all the way through. And if you do that well, even though it's hard up front, everything will get simpler long term. And that's really what we're trying to do so we can get to truly passive.
I love that. That reminds me of, the analogy of you can have two identical sailboats sailing across the ocean, both tacking with the wind. And they look like they're doing the same thing and they're all over the place. But the difference may be that one's out for a pleasure cruise and the other one's headed to an island that's 1,000 miles away. That you may bob and weave to adjust with the wind or the waves right now, but the reality is you know where you're going.
Right.
And so those tacks and those adjustments that you make that look haphazard are with a destination in mind. And I think working backwards from that is paramount. Let me ask you this follow-up question. My parents' first house, I believe their interest rate was 15%. And we all know that the best time to buy real estate was 10 years ago, and the second best time is right now, right? You don't wait and buy real estate, you buy real estate and you wait. It's a very forgiving asset class. We're surrounded by people that look like a genius now that likely probably bought a dumb deal 10 or 15 or 20 years ago. But over time, it's a forgiving asset class. Now their grandkids are like, man, I wish I could have bought that lake house for this or whatever it may be, right? When I'm hearing your model and the way that you guys are operating, the interest rate is almost irrelevant because you're making a spread and the points. So if the interest rate was 20% and you guys were lending at 23%, there's obviously going to be a lot less deals out there. But the people that know how to work with the exit in mind are working backwards. It's just a cost of doing business that needs to get factored in. It's a word problem. You're factoring that amount of money into the word problem. And it really probably doesn't matter to you what the interest rates are because you're charging a spread and you're charging the points. And the good operators know how to operate in any market. I went through a cycle where I was like, well, single family rentals is my destination before I realized that was just a stepping stone to small multifamily. And then I was like, this is my destination until I converted those multifamilies to short-term rentals. And then that was my destination. And still I started property management and then self-storage and then capital raising and syndication. And at this point, I don't believe there's a destination anymore. It is all, how can we be lifelong learners? How can we tack the sailboat? And how do we do it with a destination in mind so that we're going to get there? Do you feel like your model is something that is, in my opinion, it is timeless? There's always going to be a place for this type of lending. And this is a tool that any investor should have in their tool belt. Because the reality is there's not always one strategy that works for 100 years in a row in your market. And sometimes we have to adjust and pivot. And what we should be doing is collecting relationship equity like this and know the products that are out there and the tools that we have in our tool belt so that when the next job pops up and maybe it's a little bit different, we have a tool designed for that job. And I feel like you guys have versatility that your product is always going to be available, even though what you're lending on and the type of flips might change. What you are offering is always going to be there.
Yeah, I think for us, when we get an opportunity to sit with gentlemen like yourself and women like yourself and have you just say what you just said, I could never put it together as well. The reality of understanding how to use business tools is really what we're talking about. And then most importantly, you just mentioned relationship capital. One of the biggest fallacies, misnomers, incorrect things is all these people in real estate think it's about real estate. It has nothing to do with real estate. If you have the wrong partners, they cost you more than anything in life. And I've been through that. Those are the worst beats I ever took. The others are math equations that you can step away from, lose your money, make it on the next one, and start feeding back and getting going. But relationship building, relationship capital, that is going to take you through all different types of cycles. It's going to keep you relevant. And then, look, a lot of this is sales and marketing in today's world, right? Instagram, TikTok, Facebook, whatever. A lot of these strategies have been around since Nickerson in the 1970s. There's actually a textbook. It describes them. Now we have amazing concepts like, rent the room. Oh, no, right? That's house hack, right? We can sell you a whole course, charge you 35 grand, how to become the best house hacker in the world. But the reality is, to your point, you have to be flexible. You have to understand these strategies and understanding when these three strategies rotate, and now you have to go to the next two and how to apply those. Those are what's going to make you successful. And again, that's not just the real estate. That's the market dictating what's happening to you. And you need to be finger on the pulse, pay attention, network a lot and hear and listen and ask questions and shut up and listen.
Love it. All right. I've got one final kind of selfish question while we've got office hours with Joel Kraut. Um, one of the challenges that we really face at Nomad, and I appreciate you appear to have done a little bit of research on us based on our emails back and forth. We're essentially doing a large scale BRRRR.
Mhm.
We're buying a Kmart for $2.5 million. We're putting about $2.5 million into it. And at the end of the day, we're all in for 5 million. And at certificate of occupancy, it's worth 8.5, 9, maybe more,
As an empty
as an
facility,
empty facility.
stabilized
Yeah.
12
So
to
with,
15.
if it were a residential property, we'd go to the bank and we'd say, hey, we want to get our money out. The problem is it's commercial. Now it's commercial property, and commercial banks get a lot more, that's where we are running into the issue of, banks are not usually going to let us do a cash out refinance at CO, you know. So, we're talking about the different tools, in our tool belt, for somebody who just described that problem for me. You're an experienced lender. You've been in this space for over 20 years. What would be the tool you would use to best execute that strategy?
Well, for me, I would sit down with both of you in a room. We'd go over what the cost was and where the loan to value would sit. I'd want to approach the bank on your behalf or sit there with you at the bank. We want to talk about getting our cost out and then an earn out as we stabilize over the next 12 months so you can get more equity out. So it's a two-step approach. You get all your capital back for your investors at CO, and then maybe a 12-month IO period or 24-month as you stabilize. And there's an earn out based on a debt service coverage ratio, just like you said, a big BRRRR, where you get maybe another 2 million out. Also, one of the things that I would try to do if I was you, I would want to connect with the people who are direct to insurance companies. Insurance companies like your product, they will lend to them 10-year fixed rates, no personal guarantees, at maximum leverage, 25-year amortizations. So they're going to have more flexibility than anybody else. The MetLifes, the AIGs, the New York Lifes, people like that are making these types of loans. Northwest Mutual, big companies. They need to put out truckloads of money, right? Those interest payments are matching off for them for dividends they have to pay out, right? Those are an interesting niche opportunities for you to find lenders that aren't as obvious to the market. Have you guys done a CMBS loan, a collateralized mortgage-backed security loan yet? You'll end up with my haircut, but those can work well too.
I was
Yeah.
about to say,
That's
you say that like it's an easy thing to
Oh, no,
do.
no, no, no. It's
It's like
definitely
a proctology exam and a tax audit.
not right. But depending on what you're doing, and you guys are doing this, you're medium to high level now. So you need to find alternative strategies for financing. Private equity funds, have you gone to family offices yet directly?
We are sub family office level. We are right at the fractional family office kind of sub institutional level right now.
All right.
The last 2 years we raised $20 million from our investors, and uh, that has gone really well. And now we're getting to that point of like looking for more joint venture strategic partnership, partnered with fractional family office, partnered with some sub institutional money, and everything's headed towards an eventual PE roll up. We're in this tricky in between phase, just kind of like exactly what you said. We feel like we've outgrown a lot of the loan products that have been available for us, but we're barely knocking on the door of having some products kind of designed for us, but we're really not there. We've actually grown really rapidly. We just started doing 20 syndication at the end of 2020, beginning of 2021. We've got 150 million in assets under management from converting these buildings, which is great. But in the grand scheme of things, that's still really young, especially for family offices and institutional. So we feel like, I'm sure you're aware of the book by Dan Sullivan and Benjamin King, Who Not How, of like, we were like, how do we fix this? How do we do that? How do we do that? And we're to the point of we need a who, not a how, but specifically, we need a super who. Like, we need someone that has intimate knowledge of this type of environment that can honestly help us find the relationships where we're almost creating the type of product. Because we're, just like Neil said, we're buying a Kmart for 2 to 3 million. We'll put 2 to 3 million into it. We'll be into the whole project 4 to 6. And as a stabilized facility, eventually it's going to be worth 12 to 15. The last one we went full cycle on, we bought a Kmart in Danville, Virginia for 2.5 million. We put 3 million into it. And 37 months later, we sold it this past July for 9.53.
Congratulations.
Thank you. Excited about that, just especially because the last 3 years in commercial real estate has been very challenging. We also beat our projected investor returns, which is something that we were ecstatic about. And that's going a long way in terms of helping us with track record. But it's easy to say that and easy for people to see that, for people to want to lend on that and design a product for that, that frankly, like, that lending product is more of a BRRRR product. If we could find that, it would be great. So it's we're kind of in that in between phase and it's a little squishy. We're not quite to the level we need to be to get that preferred lending from a private bank that's going to build a product for you.
I feel like some of the people that could help you are in the prefec mezz debt scenario where they're getting that preferred return and it's carried. As you do your earnout, you get to where you want. They have one or two exits. Now they really trust you a lot and will put up all the money for you and it'll still allow you to have a nice carried interest instead of cutting you back to peanuts. So those types of people I think can be really effective for you.
Yeah, our gut instinct is telling us the same thing. I just don't think that we've got the decades of experience that you do to help us. But
Yeah,
I
but
think
you
our
you
gut
have an
felt
exit. You have a real exit that's tangible. It's a serious building. I saw the building on the website. You guys are not small. You're
thank you.
young, not small. You're doing buildings that are 25, 40,000 on the low side to 85-ish thousand, 100,000 on the big side. Those are big swatches. Those are pretty good. The market's going to respond well to that. The story you just told about going a full cycle, very few syndicators in the last 4 years can talk about that, especially the last two. Also, you are in the sexy space. Multifamily is not sexy anymore.
Yeah.
Multifamily is a problem, right? There's a sign everywhere for rent free, but you don't see that in self storage. Self storage is running the same sign since great grandma ran. First month free, talk to me, right? And technology has made this business infinitely different. It's not a grandma business anymore. No offense to grandma. I watched one of my clients do what maybe you want to do one day. They built a number of these facilities and rolled it up and sold it to Publix. And the gentleman and his family did rather well. The first build out I think we did was 10 or 12 million and it kept growing from there, 25, 30 million, just like you're describing. Facilities got a little bigger. And I think, I don't know, he sold maybe 1,000 or 1,600. I don't remember the right number, but maybe 1,600 units of space when he sold out. But it's a great business, no toilets, trash, and tenants. Investors like that because there's less movement physically from humans. That's always encouraging to money. Money doesn't understand humans and doesn't want to. So you're feeding them what they want. And I feel like that's a really good place for you to be in the next 5 years. And as you get to 50 million up from 20, that's when people in fund of funds can now invest 10%, which is 5 million, which is the hurdle they need to be at. And that will change everything dramatically for you and you'll get a multiplier effect.
Joel, thank you for turning into our personal consultant for the last 10 minutes. I appreciate that. This saves me the time of booking the call that I'm going to book with you anyway after this. Listen, for the sake of time, we got to wrap this up. I could keep chewing your ear off for a long time about this. I appreciate your willingness to share with us, with our listeners, and everything else. I'll ask the final question here and then we'll wrap it up. But one of the things we ask everybody, we should just ask everybody, what's your favorite business book? But the reality is, when you have someone come to you that clearly wants to tap into the incredible amount of knowledge that you have about this subject matter, when someone is fairly green and they're trying to learn and they're coming to you, is there a book, resource, or something like that that you find yourself recommending to friends and family more than any other?
Well, I really like the 5 a.m. club. It's a little bit different than the answer of, go read Robert Kawasaki's book, Rich Dad, Poor Dad.
Mm-hmm.
Learning how to start your day correctly, getting it organized, think about it strategically. You mentioned Dan Sullivan. Obviously, those types of books are fantastic. I'm really mad at my whole educational process because the who, not the how, was never taught to me. It was just taught to me to go do more work and spend more hours and get more jobs. And, it's great if you want to raise your income 10%, but it's not great if you want to double and 10x it. Books like that by authors like that can think slightly out of the box or out of the box. Those are places that today's market will take you and what you need to be aware of.
Great answer.
Sorry, is the 5 a.m. Club an actual book?
Yes.
Yeah.
Got it. Okay.
Yeah.
Kind of
It's a
reminds
couple
me of
million
Hal
copies.
Elrod's, the Miracle Morning.
Yeah.
Yes. I
Similar.
just finished Miracle Morning myself. Sort of a regurgitation. Not a
Right.
regurgitation. It's, it's along the same lines.
His take on it. His take on it.
Yeah.
Yeah.
Got it.
Well,
Love
listen,
it.
Joel, we're going to land the plane there for the sake of time. I just want to say thank you very much. I
Thank you.
appreciate you being here. Thank you for your time. Great to connect with you. That's one of the things I love about this podcast is that it allows us to continue to build that relationship equity.
Absolutely.
And this is a digital way for us to continue to put ourselves in a situation where we are the dumbest guys in the room. And we have certainly done that today with you. So thank you very much. If any of our listeners would like to connect with you about lending or anything else, what would be the best way for them to do that?
The easiest thing to do is just to go to BRRRR.com. We don't use bots. We use people. So we really respond. I'm some of the times as a responder. So be with 4Rs.com and we'll get back to you pretty quickly. For us, that's really important. I remember what it was like to be on the outside looking in. both as a starter and in the middle of my career getting annihilated and just trying to find people who I could build trust with again and build a business out of. So we're respectful of that. It's important to us and we want to help people with that. So BRRRR.com is a great place to get us. So thank you very much.
You've been doing it before it was cool. If you landed BRRRR.com
Yeah,
as your website,
exactly.
that is next level.
That's some good real estate.
Yeah.
You're
Well,
crazy.
listen, Joel Kraut with BRRRR Loans. Thank you so much for being here. We appreciate your time, and we appreciate the opportunity to connect with you. And I'm sure I'll be doing it again outside of this podcast.
Yeah, I look forward to it. Thank you, guys.
Absolutely.
Have a great afternoon now. All right, bye-bye.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode. Leave a comment down below or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.